Good morning. This is Tyler Tucci and Travis Nixon coming at you with Foliko Live. We've done a bunch of talking at you this week with our earnings data, earnings EPS numbers, earnings health scores. So we're going to do a bit more of an informal Foliko Live today. We're going to talk through some of our early trading experiences with Foliko data specifically. We're going to talk about some of my favorite shorts in what I kind of consider this to be the third leg of a bear market. And then we're just going to, talk some general markets knowledge. Since it is stocks to watch, we will give you a few because that would be wrong to do without.
Sounds great. Well, I'm excited to be here. I think this has been an interesting week, Tyler. We've been seeing a lot of companies coming out with quarter earnings that are down as compared to last quarter, but not as bad as feared. That's been the phrase that's been passed around over and over and over again. Not as bad as feared. And how is that translated into outcomes for us?
Yeah, I knew we were in trouble when I saw a graph of analyst revisions lower had peaked for the last 10 years. So I knew some of our earnings forecasts were kind of toast because we'd been mushed. But it's still better than expected. But I definitely will point out it's definitely not been great. We definitely haven't had any bumper earnings from everyone. Net, it's really more of is the worst priced as opposed to hey, look, good news. And I think that's important, especially in the context of this move back higher, which has a lot of people excited. We had the Fed meeting yesterday, which was very interesting because we haven't had a sequentially lower CPI print yet. And yet OIS swaps are pricing in, I believe, 100 basis points left of Fed hiking. So somebody's going to be very wrong. Either, the Fed is very wrong that they're going to fight inflation, or the market is very wrong that the Fed's going to stop. Again, our data still bearish. And that's, to me, is going to be one of the biggest, I will be very impressed at the ability of this thing to call the turn when it comes. So that is something I'm very, very much watching. We've already called the turn in XBI, and we've gone, I guess, neutral-ish banks here. But in terms of, wholesale, in terms of buying, QQQ back and the small caps back, I still think we have some wood to chop. So there's going to be a lot of things going on. We have earnings today, Apple, Amazon. We have, some more time to digest the Fed. So there's a lot of things at play here other than what's the fundamental valuation of StockX.
Now, Apple in and of itself is almost an economic indicator just by itself. I mean, it is what is 8-10% of the S&P, right? So how they do determines so much and adds context on top of what the Fed just said yesterday, right? So what's going to happen there, depending, like if you see Apple surprisingly up or surprisingly low, do you think the market follows?
It kind of has to, at least on a mathematical basis. Apple makes up a certain percent of various ETFs and indices. So if Apple slumps, if Amazon slumps, there is no choice for these indices but to go lower. But what is kind of interesting, so I think I spoke to everyone about 2 weeks ago about how Apple was setting up a potential bullish earnings divergence into earnings. And it's really remarkable because we've pretty much reverted, back towards the earnings power of about a $15 pre-earnings run higher in Apple there. So it negated our trade, but it definitely does, again, point to the fact that this earnings power line has significance. Price seems to be attracted to it both from the upside and the downside. So obviously I'm bummed that this took away a bullish earnings trade, but it's something that we're definitely keeping track of. But this is also why we're not going to give a large list of stocks to watch, because the market's going to be driven by a bunch of things, and unless you have a great prediction and an edge on those things, we can wait. We can wait until earnings clear. There's no reason to jump in here. I don't think the market is so wholly undervalued that you'll never see this price again, if that makes sense. So do you want to talk about, we had talked about my favorite shorts and kind of how I was thinking about how to be short in a bear market as it changes and moves towards the edge. Is that something you want to jump into here?
Sounds great, because that pivot point, if we can catch it, right? And that's really what we're angling towards, is how far away is that edge?
Yes, that's so. I think we have a video on short AutoZone. We've also discussed short ABBV. Those are my two favorite trades here, because I think if the market, perversely, if the market does stabilize some here, I don't think those stocks will perform as well, and I think they will lead the downside. So I like when I have the opportunity to win in both directions, or win in one direction and lose less in the other direction. That is risk reward, my friends. So I really think that those are my two favorite things to target. I'm looking at an earnings trade for ABBV, and then depending on how that goes, I'm going to set the longer term trade. I probably will do. I think I'll layer them, because if we do see a turn coming soon, you're definitely going to want to be long some shorter dated puts as well, for a little bit of convexity, in addition to building a, let's say, 3 or 4 month swing position in some, I don't know, maybe 70 delta puts, 60 delta puts. I'll have to give it some thoughts. But when calling a turn, I think you want to have different layers of the trade, because if you do get the turn right, the most explosive part of the P&L will be the shorter dated, your shorter dated options, because of the sensitivity.
So it's all about how closely we can define and nail that exact hinge point, which it's not just nailing that hinge point, it's nailing when the market realizes that it has hit a hinge point, right?
Yes, exactly. And I think, as you who have jumped into the options pool pretty recently have seen, there's a lot of other rules to that game that you don't necessarily think about, right? So do you want to kind of talk through your experience of moving? I mean, you've been dealing with this data for almost a decade, but now we've kind of moved from looking at it in a pure equity delta one standpoint to just given this output, where can I find the best edge, whatever asset, whatever expression, whatever derivative, where is the best edge? So what do you think? What are your initial takeaways? Because I think it's very interesting that, you're a unbelievably high level data scientist, but a fairly new trader. And that's what some of our customers are, in terms of, they don't have a decade of options trading experience or things like that. They have, good understanding of the markets, but, they're making a jump. You're making the jump in with our data, which I think is interesting, because I don't think there's a lot of people where you can look at the CEO using the product in the same way you're using the product, right? So I think people will care about this, and I definitely want you to talk through it.
Yeah. No, I think you've got a good point. I've got a decade plus of data science experience, but that doesn't give me an edge over our customers, because they're benefiting from the same exact data sets that I produce with that experience. So we're looking at the same data, making the same decisions. And I want to talk through how my experience has been in the past 2 weeks as I've gone from equities to options. Now, equities, I've been trading mostly on the straight Cinerai prediction of stock prices. And it's nice, you make 4%, 3%, 5% here and stuff like that. So week over week, you put this together over a year and you're looking at a pretty strong portfolio performance. Getting into options and then predicting these earnings events has been a couple things. It has been one of the most fun things I've done in years. Like this is just incredible, because you get such instant feedback. But I've also learned that I am not an experienced, seasoned trader. I have so much that I need to learn on this. Now, I had a few trades this week. Let's talk this week. I was really significantly green on just about every ticker I got this week, but I lost my gains in a lot of them because I didn't know how to properly realize them. So this came in with our McDonald's call. Our McDonald's call, we saw that the earnings power was trending a certain direction. We were capturing a lot of the market fear going into that. We missed the actual earnings event. But at one point on my McDonald's contracts, I was up 83, 85%, right? If I'd have realized that gain at that point, or rolled the options in order to at least de-risk, I would have been in such better shape than I am right now. there was several tickers that did this same exact thing to me. Now, I had a few huge blowout wins. Watsco and Visa, both of them up several multiples from what I purchased the contracts at. So great. And that almost lulled me into a trap, especially Watsco, because Watsco happened at the beginning of the week. Let's take a look at exactly what happened with them. I'll share my screen here. So WSO comes in, and let's actually just isolate this. There we go. WSO comes in, earnings event, boom, and I had puts on that. And so first thing, I didn't realize the gain right away because I'm like, oh, that's a great drop. I'm going to let it ride and get even some more out of this. And then I saw them appreciating. I got really frustrated around here, and then I finally sold the contract midday, July 26th, right? So not as good as I could have done, because I think once you capture that event that you're predicting. Now, think about what Sunrai data is doing for a second here. We're capturing some mass psychology going on about how people are viewing this stock. That's what Tyler just showed with Apple. Tyler just showed that earnings power was appreciating while the stock was diverging. And this meant that there was some kind of mean reversion that would have to happen. The way people were perceiving Apple was better than how better than the stock price was being treated, which meant that there was, I'm going to call it arbitrage. It's not arbitrage in the typical sense of the trader term, but in the strict just dictionary definition, I'm going to call it that there was some arbitrage there to take advantage of while the stock price reverted up to that earnings power line, which did happen in a significant way. How much has the stock price healed?
Probably about $15 since we identified it about a month ago. So probably a $15 move over the course of the last month.
Yeah. Now, our models on earnings are bullish for Apple coming into tomorrow. But at the same time, that stock price has appreciated so much over the past month. Who knows exactly how much they could be gaining off of that. I'm not adding Apple into my portfolio because I think that that's a little bit of a nebulous area as to whether or not that price could go up. And this leads me to the next lesson I learned today. Logitech. We predicted earnings for Logitech so well. Oh my goodness, we nailed it. It was just a thing of beauty. And let me show you what happened with Logitech afterwards. It breaks my heart. I'm showing you something, and it's still tender for me, audience. So go easy on me. But Logitech comes in, and their stock price just I think this was the earnings event right here. It was earlier in the week, and their stock price just absolutely charges forward. Now, I was able to realize a little bit of gain on the put because I predicted bad earnings, so I bought some put contracts. Their stock price just absolutely increases and does fantastically well after that. I mean, look at the news that comes out after this. They were bad on pretty much every aspect of that earnings call. And yet the stock price just did not go the way that I thought it would. Now, the next thing I learned is if you're realizing huge losses like that, don't just get rid of the contract. Hold on to it for a little bit, because sometimes the market goes your way anyway. And so right around here, July 27th, I was able to recover from a lot of those losses. And so great. But sometimes you can be right and then wrong. And sometimes you can be wrong and then right. McDonald's, we predicted that they would have down earnings, right? We went pretty big on that. Leading up to the earnings event, my options went up 83, 85%. I could have realized that gain. That was the other thing. So there's a lot of lessons coming into me on how to think about and how to trade options. When you're in the green that significantly at 80% or so, de-risk, realize some gain. And your portfolio is going to thank you for it. So does that answer the question, Tyler?
Yeah, I mean, there was really no question. I just kind of wanted to hear, your experience, because I think this is going to be important for, new Foliko users to kind of think about, okay, so this is the size of my portfolio. This is what I'm doing. How does this help me? Even if, I work with, for example, I'm working with the team on some more advanced, like positioning models and things like that. Like, you don't need to have all that. You can just, as a starting point, you can come in here, for example, and you can kind of take a look at, okay, over 4 weeks, what does Foliko think? What can how can I add this to my framework? In this case, we're bullish, XLE and XL. Well, that's interesting. So again, this is what I love using Foliko for. This is a risk off. This is a short green days kind of deal. Long energy, long utilities, long consumer defensives against short technology and banks and healthcare. So I mean this kind of makes sense to me. Long energy, short healthcare. Short healthcare versus pretty much anything at the moment. We would be happy to enter. In terms of sectors, that's probably our favorite short is healthcare, and the favorite names are again AutoZone and ABBV.
Not saying that AutoZone is necessarily healthcare unless they've made a massive pivot in the last quarter.
I mean, yeah, no. During COVID, they became the mammoth because everyone was getting 3x for their used cars, but we haven't let that premium out. I could talk about this company all day on the short side. It just seems really wrong. And obviously those are the most dangerous trades, because if really wrong can sometimes just mean you don't understand why. And that's, both humbling and very dangerous. But
what is the periodicity you're looking at for AutoZone on those contracts?
3 months, 6 months till year end. Like this is one of those, like, I think I can short this for 20% 20% drawdown, over the next 3 months, no problem. Or, at least, right? We're really shooting for a big turn and push. Same thing with ABBV. Speaking of healthcare, we have a question from Eduardo. How did you manage the HUM results? Thank you for asking. That was one of those this week that, I will say pretty good. And this goes back to what Travis and I were talking about in terms of when do you monetize? Because, we took, for record keeping purposes, we sold our Foliko Live trade at 14 from 10. So that's a pretty good trade. But had you held, I believe, until about 10:30 or 11 Central Time, those puts almost got up to 21, 22. So that would have been a clean double. So that's something that we are very, very working very, very hard at, is figuring out if we can optimize the entry and the exit point beyond just we have the edge over earnings, so be long over earnings or be short over earnings. We're trying to distill. The next trick will be to distill down to be short till 9:30, be short till 10. We want to be systematic about what we're doing, and that's why when we go over our report card on how our trades did, I basically took the price of all the options at the same time. I assumed no trader kind of overlay whereby I would have held things longer that went up or down and were advantageous to my position. So we did not do as good of a job as hopefully you all did, if that makes sense. Because if you held, I believe you pretty much got higher prices on your puts all day long. So that was a good one. Thank you for asking. We can feel a little better about that.
We love questions that make us look good.
Right? Yeah. So thanks for that. Keep going.
Let's just not talk about McDonald's, huh? Right. No questions on MCD. But I will say this. So, for example, just to emphasize what Tyler's saying, I went big yesterday on 3 earnings names coming out just this morning. So Hog, which Harley Davidson, Hershey, and Southwest Airlines. So Harley Davidson, fantastic. I think pre-market. So these were calls that I purchased in pre-market. They're up 6.1%. I'm deeply in the money. So I have a strike price of 35 on them. So that's going to be fantastic. But I'm not going to wait anymore. I'm not like, there is no more like, oh, I hope they go up another 4% or something like that. No, I'm done. I am selling these calls as soon as the whistle blows at 9:30. They are out of my portfolio. I'm going to realize the gain. Hershey, same deal, in the money. Southwest, same deal, in the money, except it was puts on Southwest, and now they're down 6.1%. 6.1%. Now, that's an interesting one because they actually reported good earnings, but we caught that psychological factor, right? There is, on the whole list of all the options I got, which I went through, and I got maybe 15, 16 tickers this week that I was making earnings bets on this week. We really messed up and never had I really messed up and never had a chance for profit on one of them. And that was Range Resources. And I got to say, that was honestly just a mistake of reading the data. Like, I literally read the data wrong. I was on such a high from Watsco that I was just buying stuff, and Range Resources comes up. I'm like, yeah, screw oil. So I completely destroyed it on Range Resources, but every single one of them has been significantly green at some point. So if I had had the right trading fortitude, this all would have worked out quite well. I'm excited to realize the gains on these three so that I can really make the portfolio work for me this week.
And it's amazing because we were talking about this before the show. I could give 10 people the same 10 stock picks and say, trade these, and I'd probably get 10 different equity curves because there's just so much more than picking stocks. I mean, that's 20% of the battle. 80% of the battle is, can you manage the risk? Because I mean, that's really where the difference is made. Again, to point to Foliko, it's nice to have a process and something, supporting your process as opposed to just, because it feels a little dark, by yourself. The numbers start turning, you have no idea, the price starts moving, you have no idea why. This is definitely helpful for us.
Yep, absolutely. It's you get that conviction, you get that theory. I will say on this, what you're showing on the screen right now, so technology being at minus 10%, bottom of the stack. I think that the problem with technology being at minus 10% for me, and why I agree with your focus on healthcare right now, is that we're starting to see prices go up on bad earnings. Look at Google. I got the earnings right. Google did report bad earnings. And yet the phrase that chart, I mean, they were up, 7% yesterday after their bad earnings report. What I think is funny is that Microsoft made almost the exact same report. Like, it was almost the exact same thing, and Microsoft was down 3% on the news. They did recover when Satya got on air, which always happens because he's like the most, I swear he hypnotizes people while he talks, because while he's talking, you just feel better about yourself in life, right? So their stock did match up with Google eventually. But my point being, I don't think that the market really knows what to do with tech right now. I think there's a camp that thinks that this is the bottom and they're just charging up. There's a camp that thinks tech will never rise again. There's a camp that thinks that it's just going to go sideways. And I find myself in that latter camp more and more and more. I think tech is just going to be crawling. So it is the crab market going forward for the next year. It is just a sidewinder. So I'm not big, unless you have really strong tickers individually within tech. I'm not big on making that bet personally. How about you, Tyler?
Yeah, same. I mean, our initial FANG analysis stands until proven otherwise for me. Talk to me in September, October. I really just have the, not that anybody cares, but I really just have this feeling we have one more puke lower left, at least.
Well, look at the Fed reaction yesterday, and this tells me it's still not a serious market.
Yes, right? and well, I mean, yes, to that point. In a bear market, positioning explains a lot more than it does when things are trending up, because a bear market is mostly just about pain. So we just need to hurt some people, for lack of a better term.
Well, and the Fed comes out 75 bips up, and they say, eventually, maybe, sort of, we might calm this down to 50. 50 is still fast.
50 is still historically fast. That's, yes. We're going to go from breakneck, to use the Spaceballs term, ludicrous speed. We're going to dial it back down to 50 bips, which is also fast as lightning. So, And by the way, we haven't had one inflation print sequentially lower yet. So that's a fascinating one that Chair Powell was saying, I'm thinking about slowing down, but I swear to God, I'll fight inflation. I mean, inflation printed 9.1. Kramer thinks that inflation has hit the highs.
Which he did like a month ago, didn't he?
No, he doubled down yesterday.
Well, I think his quote was, "Oh no, it's done. Inflation has peaked on the raw materials. On services, it could go wherever."
Right. So next CPI print, 10. But that's neither here nor there. The point is, the Fed is telling, the market wants the Fed to stop hiking and say mission accomplished on inflation when we haven't been able to even flatten it off. And by the way, there are so many other things driving inflation that the Fed has zero control over, so that doesn't surprise me. I am starting to get worried that this drawdown in the U.S. oil reserve is ultimately going to be a catalyst for another leg higher. And that would be a complete nightmare because that's uncontrollable inflation, and oil is at 130 and the Fed's hiking till 10 to cause a recession to get the price of oil to drop. That's something. That's a chain of thinking that potentially could happen. But it'll be interesting. I mean, go ahead.
Let me paint another narrative and get your thought on it. Fed does a surprise meeting in August because they're scheduled not to, right? They do a surprise meeting in August after some bad CPI numbers come out. And that is the last leg because the market realizes Fed's meeting, whereas they were slightly dovish last time, they're coming in, they're raising another 75 mid where they should be. And that's it. That's the point where we start talking pivot.
I've been doing this long enough, not that long, but long enough, that if the Fed calls a surprise meeting, like fasten your seatbelts. Yes, I don't think they'll call for a surprise because the signaling of it is so aggressive. If they call a surprise meeting to go historically fast, like, I don't know how much more hawkish you can get, right? Like, we're so hawkish, we literally couldn't wait 4 weeks. I actually think, just kind of thinking out loud, we're more likely to see 100 bips at a scheduled meeting, and they'll take that whole time to set it up. Then an emergency meeting to do 75 to then do, another 75 or whatever. But the OIS market has, I think, another just 1 point of hikes left. So that's like, 250s and done with inflation not having rolled over yet. So that's a very interesting one. I don't know how people have gotten there. In my experience, the best way to trade the Fed is to just listen to them. And, I'll get absolutely flamed for saying that. Like, people are like, oh, the Fed's not clear. They are. They're super, super clear. Especially, the edge is usually the chair. In the Yellen days, like, every time there was some volatility, you could always count on her to be careful. Every time. There was some volatility as it related to CNY and the peg and some devaluation, and she was supposed to be tightening in September. And everyone was the market priced it, all this stuff. Everyone was absolutely shocked when she was like, "Nah, I'm good. We're going to hike in December because I want to be careful." And there was everyone was pulling their hair out and all this stuff. And it was like, have you been watching? Every time. She's careful every time. She shows up to the airport 4 hours before. This is true, I believe. I think
really?
She's at the terminal like 3 hours before her flight. So do you think someone who is at their terminal 3 hours before their flight is hiking rates into a currency crisis? Like, no, never was.
They're putting her in a lounge that I never get to see the inside of my whole life at the airport, though. So her time 3 hours at the airport is not my time. I'm next to 15 screaming kids, McDonald's being thrown at me. She's like listening to some concerto, sipping champagne. So I would show up 4 hours early to the airport if I lived her life.
Oh, I'd be rolling in 7 minutes before the flight took off.
Tell the plane to wait for me.
Yeah, I'll be right there. Yeah, absolutely not. But I think it is important to play the chair as well as the board. Powell's been completely tone deaf before. He ruined the market so badly in 2018 at the December press conference. His next public speaking event was he was flanked by Bernanke and Yellen like the Keystone Cops. Like, I'm pretty sure there was somebody in the audience with a trank dart where if he was like, we're going to continue quantitative tightening, it was just going to be like down. You know, and Bernanke was going to come through the wall like the Kool-Aid man and be like, QE4. Like, the whole thing was set. So I don't think there's any reason to believe that he won't bungle this again, especially because it's inflation that's the enemy at the moment. So
well, I don't think he's got a choice. Everyone talks about what will Powell do. What do you mean, what will Powell do? Look at the CPI print. That's what Powell will do. Like,
that's the question, though. People don't believe that he has the will to do this, and that is ultimately the bet. It's all one trade. Is do you believe that Powell wakes up in the morning and checks SPY futures, or he checks the inflation nowcast? If he checks the inflation nowcast, you're short. If he checks SPY futures, you know, you'd probably start buying them, or, you know, selling puts or whatever. But like, that's the whole deal. Is he willing to break inflation, even if inflation is not something he totally controls at the moment because, you know, of the juxtaposition of all the inputs?
Well, so now let's do talk inflation for a minute, because we are seeing raw materials reducing in price. Like, I mean, lumber, aluminum, a lot of these big inputs are just absolutely screaming downwards, right? And aluminum was a huge deal. I mean, aluminum was really bungling things up for a while. So there is actually reason to think that we may have reached peak inflation, especially on raw materials. Now, if we're just hitting it high in the services, then that means that unemployment needs to go up in order to control those costs. But look at housing. Housing is really starting to turn, right? I would not want to buy a new house right now for any, I mean, no matter the opportunity, I would never buy a new house right now. And I think that's where a lot of the market's heading. And a big chunk of our inflation has been housing. It is entirely possible that we could see some better prints in the months to come.
What's interesting about the housing thing, though, is we've kind of seen an offsetting squeeze in rents because of what's happened with the rent buy equation as a result of mortgage rates moving higher. So that's, I mean, the whole thing is just, it's a very weird time. And, you know, people always say stuff like that, but I believe it was Druckenmiller who was talking about everyone likes to talk back to the Volcker, you know, the Volcker days and kind of juxtapose this and that. It's not the same. And, you know, the unemployment rate was 9 or something when he started breaking everything. We're jamming on the brakes we're at 4, you know, so it's so different what's going on. And the way that this fallout could, you know, occur and roll down is just different than what we had seen before, because this is taking a hot growing economy and crushing it, as opposed to crushing an already crushed economy to save it, you know. Yeah, so we'll see, but we need to, if you're long risk, you need to see a sequentially lower CPI print next. You know, I don't think 3 months down the line argument is good anymore. That one worked in April. If you told me by June we'd be slowing, I'd be like, okay, cool. But now we're in August and we're not slowing. So we need to be slowing pronto. Otherwise, you need to give him, if you think he's going to, by he, I mean Powell, if you think he is going to stop hiking, the market needs to give him a reason. So we could talk about it. If the next print is 6.5, right, and we've dropped, you know, 3 handles, okay, that probably get it, right. Like, so there are ways to get there, but like none of the ways we've seen lately are the ways we get there. You know, if inflation prints at 9 again, like, you know, hello 100, my old friend. Like,
and I will say, as far as the data we carry, and I would argue the data that everyone else carries, there's no great way to discreetly predict that. You're making a bet, and I think that's dangerous. Last question for you, and then we got to go. Semis. I think it was the Senate just passed the bill, or is it? Yeah. Anyway, House or Senate just passed the bill. Looks like it's going to go through on a clean sweep on the other side, right? Does that? I mean, you have been bearish on semis for quite a while. Does this change the picture?
Yes, I mean it certainly throws a floor under what the downside case for American semis is. Just like Boeing in the last decade got that huge boost because it was a de facto semi-sovereign. These chip makers are part of the US's defensive future, especially if what's going on in Taiwan comes to a head. There's got to be other ways to mass produce semis. So yeah, I definitely am not. I'm not shorting semis here. I will consider shorting semis again at higher prices, especially if Foliko data doesn't change its mind, which it really hasn't. But yes, here probably not yet. I just think kind of generally not yet on the whole market on the reshort. We had talked about this. I had seen up to 4,300 in SPY before the reshort because we could just squeeze that high. So, and that's another thing we had talked about was I just don't. There are 252 trading days in a year. This is not a great day to make a call on. You're threading the needle between the Fed yesterday, Apple and Amazon after the close. There are just better edges and better setups. So if you want to gamble on earnings, you absolutely have my blessing. But just realize that you're gambling. Except for the ones that we picked. We think we have an edge on those, by the way. But aside from those, you're gambling on the rest of them.
Speaking of gambling, I'm going to go cash in my chips because 9:30 is approaching. Hog is still doing amazingly well. Southwest, I think it's going to be an exciting day for my portfolio. Hopefully, everyone you're working with Cinerai Foliko data, and you're going to be able to realize the same gains. We'll see you again next Monday, 8:30 a.m. EST. Thank you, everyone, for joining. Happy trading. We'll see you soon.